Hello, and welcome to the Certified Equity Professional Exam Overview webinar for Level 1. This segment of the webinar is focusing on corporate and securities law. My name is Pam Chernoff, and I am the curriculum coordinator here at the CEP Institute. We're providing this webinar to help you in your exam preparation process. The Level 1 webinar is being conducted by Christine Zwerling, who is Senior Manager Equity Operations at Twilio. She is also a member of our curriculum committee on the law panel.
Hi, Pam.
Hi, Christine. So for Level 1, 25% of your test questions will be on corporate and securities law topics. You'll probably see a little bit more than 25 questions because your exam will have 110 questions total, but only 100 of those are scored. The other 10 are items that we are collecting information about to see how they perform. Those 10 experimental items are just mixed in with scored items, and they are not marked, so you're not going to know which ones those are. But as a result, you'll probably see one or two more than 25. And then the list on this page is just looking at some of the high-level topics that come into play on the Level 1 syllabus. And on that note, I'll hand it over to you, Christine.
Great. Thank you, Pam. Okay, well, jumping into the first slide on corporate and securities law. So the first thing that we're kind of learning about when we're learning about the corporate and securities law is kind of how do we finance companies? And there are different ways that companies can be financed. All businesses need money to operate. And there are two main ways for companies to get this money. One is to borrow. A new company might be started with just a couple credit cards. I think we've probably all seen those stories where somebody started a company with credit cards. Twilio itself happened to be founded by our CEO, I think, sold wedding gifts and then used that money. I'm sure his wife appreciated that. You could also use bonds or loans from banks and so on, but they have to be paid back. The other is through equity ownership, sharing a portion of the company. So that's selling pieces of the company. It does dilute the ownership, but it raises money, and there aren't any requirements to repay it. The purchasers of the stock have no guarantee of any return, but they now own a piece of the company. Different investors get in at different times and different levels with different risk levels. Much bigger risk to buying stock pre-IPO than buying shares once they've gone public. And there are generally two classes of stock, at least pre-IPO. Post-IPO, a lot of times you'll see just one class of common stock, but there is common and preferred stock. And preferred is just that, it's preferred. Usually there are better benefits, better conversion rights, better liquidation rights, usually for early investors. So a lot of times you'll see preferred stock because they're taking a bigger risk in a pre-IPO, maybe a first round of financing kind of thing. So they want to make sure that they get paid back before people who own common stock. And that's exactly what that sounds like. It's just common. It's a very basic form of ownership. A lot of times what you'll see too is preferred stock might have additional voting rights, that type of thing. And then for corporate structure, the board of directors is the only body that can legally issue stock to new shareholders. So that's the reason that for what we do, the board has to approve all equity compensation plans. So shareholders own the company, but they hire the board to run the company, to hire the management team, issue stock, that type of thing. And along with that, all corporations, once they're public, have reporting obligations. You'll see they do the annual report on the 10K, quarterly reports on 10Qs. They have an annual shareholder meeting for the shareholders to elect the board and vote on any other items that need to go to the board, to shareholders for vote. And then there could also be special meetings for anything unusual that's going on, acquisitions, that type of thing. Go on to the next slide. So for the board of directors, what is their job? What do they do? A company's board of directors has a lot of responsibilities, and in addition to policy-making decisions and decisions about hiring and firing of corporate officers, the board is responsible for approving the company's equity compensation plans and other roles listed on this slide. So major policy decisions, appointing or removing officers, adopting equity plans, standards of conduct, the board The board's decisions must be done in good faith and in the exercise of reasonable business judgment, and then they must not have any conflicts of interest. They must be have a disinterested view when approving matters. So you wouldn't have somebody on the board who is also one of the officers of the company, and then they're making compensation decisions, because they would be then making decisions about their own compensations. That wouldn't be a disinterested party. You also wouldn't want somebody on the board who's one of your largest vendors, because you may make decisions that are preferential to that vendor and not to the shareholders of the company, that type of thing. Any delegation of responsibility must be reflected in the plan document. If the company is public, there may be specific requirements to grants, to make grants to executive officers. So a lot of times what we'll see, especially once a company goes public, is the whole board may approve a new stock equity compensation plan, but the individual grants that are made to employees, a lot of times you don't see those made by the whole board. The board will designate a committee to do that. The compensation committee, or maybe the compensation committee will even designate an equity compensation committee who can approve those types of things within certain ranges. But those all have to be documented and done in the proper order. See, so moving on to corporate governance. If a company is listed on a stock exchange, its equity compensation plans must be approved by shareholders. And that goes for the two most common ones that we deal with, the New York Stock Exchange and the NASDAQ. The New York Stock Exchange has specific requirements, and the NASDAQ has specific requirements, and you can see those on this slide. For example, the New York Stock Exchange requires listed companies to have compensation committees made up entirely of independent directors, and the committee has direct responsibility for determining the CEO's compensation and making recommendations to the full board about non-CEO executive comp. And then NASDAQ requires listed companies to have written comp committee charter that specifies the committee's responsibility for determining and recommending compensation for the CEO and the other executive officers. There should be internal controls to limit granting authority. For example, the maximum grant size that the comp committee is authorized to approve. And this goes for, as I had said on the prior slide, that some companies will set up like just a smaller committee that can approve equity grants. They'll do the same thing. They'll say, this equity granting committee, and usually it's two people, one or two people on the board, depending on, again, what the requirements are for the exchange and for whatever different other rules could be covering this. It will say they can grant up to a maximum of this. No one person can get more than this in 1 year, or within certain ranges, that type of thing. So that will all be spelled out in the document. And that's something, if you're administering these plans, you'd want to have a copy of that document to ensure that you're not violating what the comp committee charter says that it's going to do, or the whatever committee you're working under. Okay, moving on. Just more rules that we're under. So the governing law that governs the issuance of shares and disclosure of information about the shares of stock are set by the Securities Exchange Commission, which is an agency of the federal government that administers the federal laws regulating the offer and sale of securities within the United States. The Securities Act of 1933 is a federal statute that requires that shares be registered or qualify for an exemption of registration before they can be bought or sold. This is meant to ensure that investors have certain information before purchasing shares directly from the company. So notice the date. This happened during the Great Depression. And so this was, the Great Depression happened because there was a lot of insider trading and the markets crashed. And then the government came in and said, we need to put some things in place to prevent this from happening again. So this particular regulation only covers people from buying and selling from the company, not in a secondary market. And that's where the Securities Exchange Act of 1934 comes in. That governs purchases and sales of shares in security markets. This includes providing investors with access to adequate information about the company. The company must comply with reporting, proxy solicitation, and tender offer rules. People trading shares, including company employees, must comply with insider trading rules. This act regulates investors who buy and sell stock regulates the brokers, the transfer agents, investment advisors, and the marketplace where the shares, where these transactions take place. And then lastly are the blue sky laws. These are the state securities laws that govern the purchase and sale of securities. These are distinct from the federal laws governing securities, but they often match or complement the federal securities laws. The phrase blue sky originates from a federal case that described such laws as aimed against speculative schemes which hold no more basis than so many feet of blue sky. So I find, and Pam, I'm assuming you're in a similar place, the blue sky laws typically become more prevalent in the life of the stock administrator for a private company, because you're starting to issue shares in each individual state, and you need to make sure you're qualified and doing everything according to the securities rules in those different states. Whereas once the company goes public, it's assumed that you're dealing with all the different states and covered under the federal regulations, which tend to work hand in hand. So, until I worked for a privately held company, I actually didn't see the blue skies laws come up very often. So, okay, digging a little deeper into the Securities Act of 1933, the 1933 Act changed, I'm sorry. Again, the Securities Act of 1933 is a federal statute governing the offer and sale of securities in interstate commerce, prescribes registration, disclosure, and anti-fraud rules. Before this act, case law showed that judges actually ruled that people working for a company could use any inside information to their advantage. It was a recognized advantage of working for a company. And just an aside here, I actually a few years ago, not at Twilio, had an employee ask why we had the insider trading rules, and specifically said, "Isn't it a perk of working for the company that you would have additional information and you would know when to trade the stock?" It's just like, no, that we stopped doing that almost 100 years ago. So I think a lot of employees don't understand this yet either, and you may need to explain it to them or make sure they understand that they should not be trading on material non-public information, because that is what this act is trying to prevent. So the 1933 Act changed that by setting rules intended to allow all investors the same level of information. So all companies must register all shares that are going to be sold, use an S1 for an IPO. The S1 registers the initial share offering to the market. And then an S8 is specific to shares being sold pursuant to stock plans. So ESPP, restricted stock, options, all that. And this is only for public companies. It can't be used by private companies. An abbreviated registration, it's an abbreviated registration statement incorporating information from other publicly available documents. And that's why you have to be publicly traded. If you're not yet public, or if you want to offer shares that are not going to the general market, there are some exemptions that fit. Two main exemptions in the equity compensation world are Rule 701 and Rule 144. And the next slides will go into those in a little more detail. But basically, Rule 701 is for a company to issue stock to employees under a compensation-related plan. And then Rule 144 allows shareholders exemptions for reselling that stock. So let's go ahead and move on and dig a little deeper into the S8. So the Form S8 can be used anytime after becoming subject to reporting requirements. It's a simplified registration form that's available to publicly traded companies that are issuing stock to officers, directors, and employees under an employee benefit plan. The filing consists of a plan prospectus and a registration statement that registers a fixed number of shares. The S8 refers to the employer's reports under the Securities Exchange Act of 1934, which we'll talk about in a bit. And as a result, it does not have to be updated for future filings under the Act. The prospectus includes general plan information, a description of the securities being offered, a description of the tax consequences to the participants of the plan. And this is something when you're disclosing your equity compensation grants to people, you'll give them a copy of the plan and a copy of the prospectus. And this prospectus is typically written by attorneys, and it's supposed to be kind of a general FAQ type document. But I got to tell you, it's still written by attorneys and the employees don't understand it. So legally you have to provide it, but I typically also provide something that's in a little bit more real English for employees too. But that's just an aside. So filing the S8 allows non-affiliates to resell the shares. The affiliates, however, are still subject to most of the provisions of Rule 144 before reselling. And on that one, let's go to the next slide and talk about Rule 144. This registers the stock, or if you're registering the stock or finding another exemption. Rule 144 has two different purposes. The first is an exemption from registration. This applies to restricted securities, which are not the same as restricted stock as an equity vehicle. Restricted securities are shares that are acquired in an unregistered offering that cannot be sold unless they are first registered or sold subject to an exemption from registration. The second use of Rule 144 applies to control securities, and these are shares owned by affiliates of the company. This part of the rule applies to all directors and certain executive officers. All company stock owned by affiliates must be sold under Rule 144. It doesn't matter how they got the stock. It does not matter if the shares are registered. Affiliates always have to sell under this rule. So remember, and this took me a while to understand when I was studying for the CEP, that there are two very distinct purposes of Rule 144. So again, one is restricted securities, an exemption from registration. Two, control securities, shares owned by officers and directors. Those two things. So digging into Rule 144 a little bit more, for the registration exemption part of Rule 144 to be available, the company must be current in its reporting. The individual must have held the shares for a certain period of time, which you don't need to calculate until level 2. So we'll talk about it more on the next webinar. The shares resold in a 3-month period may not exceed the greater of 1% of the company's outstanding stock or the average trading volume of the preceding 4 weeks. And the shares must be sold through a broker or market maker. As for sales by affiliates, again, regardless of whether or not the shares are registered, the affiliate must file a Rule 144 form reporting sales in a 3-month period that are 5,000 shares or $50,000 in value or more. So there is a de minimis rule. I have heard some people use that to they're only selling 100 shares with, a value of $500. We don't need to file a form. It's, definitely an out there, but it's one of those things that I always have people check with counsel just to make sure you're just not willy-nilly not filing a form, because again, it's looking 3 months out. So it's possible that maybe 2 weeks later, they're going to have another sale that's going to be over the minimums, but that really started with the prior sale. So a lot of times people will just file a form no matter what, but that's something to think about. There is a de minimis rule, but it may not be something you can rely on. So anyway, going on to Rule 701. Rule 701 is a different exemption from registration. It's available to private companies that grant shares for the purpose of compensation. It's only available to private or pre-public companies, but there are limits. Additional threshold triggers and additional financial disclosures. If the aggregate sales price exceeds $10 million in a consecutive 12-month period, then the company must release more financial information, including financial statements. And this is one of those things, again, this is for private companies. A lot of times private companies don't want to release financial statements to the public. So this is something that those companies need to keep an eye on. And be very conscious if they're getting close to that limit, what they're having fall under Rule 701 and outside of that as an exemption from registration. When you use an exemption, the stock that you issue or sell, the shares are restricted since they're not registered. Until the shares are registered, you can't just walk down the street to a local brokerage office and sell the stock. So that's, something to keep in mind. Now to switch gears a little bit, we're turning to the 1934 Act, and we're going to talk specifically about Section 16 of that Act, which focuses on information disclosure. One of the primary provisions, at least for CEP test purposes, of Section 16A requires directors and certain officers and principal stockholders of public companies to report to the Securities Exchange Commission all transactions in the issuer's securities. Section 16B requires such persons to disgorge any short swing profits received from transactions in the issuer's securities. These insiders must report on beneficial ownership. Means these insiders must report on their beneficial ownership. And that means that the insider is responsible for reporting not just his or her own transactions, but any made by a spouse, children, parent, or other relative sharing the same household. The insider is considered to have ownership in shares owned by those people, so transactions in those shares are subject to the same requirements as shares held by the insider. Let's move on to dig a little bit more into Section 16A, the actual reporting of the transactions. There are 3 forms required under Section 16A, and they are the Form 3, which reports an insider holdings in company stock when the person first becomes subject to Section 16. If the company is newly registering its shares, for example, because of an IPO, the Form 3 for all Section 16 officers is due prior to the effective date of the S1 that we had talked about before. Otherwise, if they are just becoming promoted into being a Section 16 officer, the Form 3 is due within 10 calendar days of becoming an insider. The Form 4 reports any change in beneficial ownership of company shares held by an insider. There's a long list of things that are subject to or exempt from this in your textbooks, and you should be sure to be familiar with that before the exams. The Form 4 is due within 2 days of a transaction that triggers it, with a narrow exemption that doesn't come into play on level 1. We'll go into more detail about what's reportable on the next slide. And then the Form 5 is a year-end statement that details changes in beneficial ownership that were not reported on Form 4. This is only needed if a transaction wasn't reported on a Form 4. If a Form 5 is needed, it's due within 45 days of the company's year-end. The transaction types listed here are not required to be reported on a Form 4. However, they can be voluntarily reported on a Form 4 instead of a year-end Form 5. So something to keep in mind with a Form 4 and a Form 5. Again, the Form 4 must be filed within 2 business days of a transaction occurring, and then the Form 5 is done within 45 calendar days of the year, the fiscal year end, and has to include transactions that weren't previously reported on a Form 4. So with this, what that does not mean that you can skip a transaction that has to be reported on a Form 4 and just report it on a Form 5. What it means is that if there was a voluntary transaction that was required to be reported, that needs to be reported through the year but is not required to be reported on a Form 4, you can report it on a Form 5 at year end. However, all of those transactions can also be voluntarily reported on a Form 4. If you miss reporting a Form 4 transaction in a timely manner, you must still report it on a Form 4, but now it's a late Form 4. So you can't hold a Form 4 transaction and just report it on a Form 5 later. There's a small number of transactions that can be reported on a Form 5, like gifts and transfers and that type of thing that are mentioned on this slide. But you can also voluntarily report those on a Form 4, which I think is what most companies do. But that's just something to keep in mind, that there's a difference there. Okay. Looking a little bit more deeply into those reportable Form 4 transactions, the most common ones that we deal with in stock admin are grants of options, stars, and restricted stock, exercises and withholding of shares to cover taxes upon exercise. There's a number of things, and you can read them here. You don't need me to read them to you. But this is a list of transactions that must be reported within 2 business days on a Form 4. And again, if you miss one of these, if say some amendment is made to an executive's option a grant and you don't find out about it for a week and you're doing the form filings, you still need to file that on a Form 4, but it's now a late Form 4. Okay, let's go on to the next transaction, digging again a little bit more into Section 16A reporting. This is exempt transactions. So there are some transactions that are exempt from reporting altogether. The result of these events, however, are reflected in the total ownership column on the next Form 4 or Form 5 filing and are explained in a footnote to that filing. So they're listed on here, and again, they're detailed in your textbooks, but some of the things are like an expiration or cancellation, except if the insider receives some kind of compensation for the cancellation, then that's reportable. Otherwise, if they have an option grant that just expires in normal course of business, you don't have to report that. Non-material amendments. This includes things like acceleration of vesting or addition of new exercise methods. So say you add, the ability to do a same-day sale to your exercise methods. You don't have to do a separate Form 4 reporting for that. And then vesting. The vesting, this is something to keep in mind. It depends how you report your RSU transactions. The vesting of an RSU may or may not be reportable. If the RSU was initially reported as a derivative security, again, that's where you're going to derive something from that award, then the vesting is reportable on a Form 4 because you're going to be issuing shares of stock. However, if it was reported as a non-derivative security, if you put this on the table 1 saying they just have shares of stock and just footnoted that it's part of a restricted stock unit, then at the time of vesting, you don't have to report that you're vesting shares. It only has to be reported if it was the vesting event, if you're moving that ownership from a derivative to a non-derivative security. Okay, this is my favorite part of the rule regulation, moving on to Section 16B, matching. So I love any statute that has disgorge in it because it's kind of fun. So short swing profits recovery period, that is, any profits must be returned to the company if purchased within less than 6 months of the sale, or a sale within less than 6 months of the purchase. And it matches the highest sale price with the lowest purchase price, even if it wasn't directly related. You're just going to look at any purchases and any sales that happen within a 6 month period. There is no defense to the application of the provision. You can't say, oops, I forgot, or I was a week off, it was kind of close. There's no wiggle room in this. There's no leeway. An officer or director cannot make a matching transaction within 6 months of each other. However, most transactions in stock plans are exempt from this rule. So let's see. And we will, I think in your materials, it goes into that a little more detail. And I think we go into that more detail on level 2. But moving on to the next slide, under Section 16, post-termination, when somebody stops being a Section 16 officer or director, the Form 4 reporting requirement is required for 6 months after the last transaction while still a Section 16 insider, and only if they are matchable under Section 16B during that time. So if you have an officer who sells shares of stock immediately before they stop being an officer or director, they cannot purchase shares of stock for 6 months after that. Otherwise, it would be a matching transaction. But if you have an officer who sold shares of stock and then 6 months later terminates employment, they're done. They don't have any, they wouldn't have anything else to match against. So. Okay, and then looking at a little bit more of the kind of reporting requirements, you've probably heard around your company them talking about CD&A, and that's the compensation discussion and analysis that's released in the proxy statement usually. Under Regulation SK of the Exchange Act, requires the disclosure of the compensation of certain named executive officers of the company. These include everyone who has served as CEO or CFO during the previous fiscal year and the 3 other most highly compensated executive officers, and up to 2 additional people who have been among the most highly compensated executives, except for the fact that the individual wasn't serving as an executive officer of the company at the end of the last completed fiscal year. These disclosures include several tables detailing various aspects of compensation. At level 1, we're concerned about 2 of them: the compensation discussion and analysis, and the summary compensation table. The compensation discussion and analysis, or CD&A, is the narrative describing the company's executive compensation programs. It discusses the objectives and policies of the company's programs and how they are implemented. The disclosure requirements cover the topics on this slide. Okay, and then going on to the summary compensation table, that is the centerpiece table of the proxy. It gives an overview of the company's executive compensation actions and decisions. Each element on this slide is listed separately along with the total for each column. For stock and option awards, the amount reported is the full grant date fair value for financial reporting purposes. So even if a grant vests in a later fiscal year, it's reflected in the year granted, not in the year that it became available to the executive. Okay, moving on a little bit to talk about insider trading regulations. As a general rule, any person with material non-public information about the issuer is obligated under Rule 10b-5 under the 1934 Act to refrain from purchasing or selling common stock until such information has been released into the marketplace. This applies to executives who, for example, have access to earnings reports before investors do, but it isn't limited to executives. An employee or anyone else who knows that regulatory approval for a major product is either imminent or is not coming has material non-public information and can't legally trade company stock until everyone else learns of that news as well. So this is really that part of the SEC provisions that are trying to make sure that insiders and external shareholders are making investment decisions based on the same information. Okay, moving on a little bit more on insider trading. Rule 10b-5 or 10b. Prohibitions on trading while in possession of material non-public information extend into equity compensation. Although stock options and stock appreciation rights may be exercised at any time, even if the holder has material non-public information about the issuer, that person is obligated under Rule 10b-5 to refrain from selling common stock acquired under exercise of an option or a stock appreciation right until the material non-public information has been released into the marketplace. And in fact, most companies have trading policies that would prohibit an exercise in that circumstance unless it was under Rule 10b-5-1 plan. For purposes of Section 10b of the Exchange Act, an individual is considered to have traded on the basis of material non-public information if he or she is aware of information at the time he or she made the purchase or sale of securities. But the rule also provides an exemption by providing an affirmative defense to this awareness standard for determining insider trading liability. If the individual has, 1, entered into a binding contract, provided instructions to another person, or adopted a written trading plan before becoming aware of the material non-public information, and 2, the binding contract, instructions, or written plan expressly provide by amount or formula the amount, price, and date of the transaction, and 3, demonstrate the transaction in question was pursuant to a binding contract, instruction, or written plan, then the binding contract, instruction, or written plan will act as an affirmative defense to a claim of insider trading. This exemption allows insiders and others who are often in possession of material non-public information to institute individual trading plans called 10b-5-1 plans that conform with the rule by specifying either the timing or price at which shares will be automatically sold or purchased. This plan must be put in place at the time when the person is not in possession of material non-public information. And a little bit more on company trading policies and practices. To ensure that employees do not run afoul of insider trading rules, most companies put trading policies in place. Some of these policies cover only insiders, others a broader group. These trading policies often have set blackout periods when no trading in company shares is allowed, and window periods when trading is likely to be safer than at other times. For example, a company may impose a blackout period that starts before the end of the quarter and ends a few days after the earnings are announced, followed by a window period once the market has had time to absorb the earnings news. And I find that it's very common to have this apply to all employees, I think, depending on the size of the company. But frequently what you'll see is anywhere from 2 weeks to a month of the last month of the quarter, they'll close down and put a blackout in place until the earnings have been announced. And then once the earnings have been announced, there'll be a slight cooling off period while that information is disseminated. It could be 1 day, 2 days, 3 days. I think they vary, but I more commonly see 1 or 2 days. Then they'll have an open window period until towards the end of the quarter when the window will close. So that's probably something that as the administrator you would have to make sure that you're helping employees understand what those trading periods are and helping them either block or open trading during those various periods. Okay, let's shift our attention to the Sarbanes-Oxley Act of 2002. Oh my gosh, I haven't realized that it had been so long. So under the Sarbanes-Oxley Act, and this is SOX of 2002, a public company may not extend, arrange for, or renew credit in the form of personal loans to its executive officers or directors. Companies are required to promptly report changes in top management in its top management and directors, adoption or amendment of employment contracts, and any other material executive compensation or benefit arrangements. Section 5.02 of Form 8K requires a company to report when it enters into or terminates material definitive agreements, including employment agreements, compensation and retirement plans and agreements, and deferred compensation plans covering executive officers and directors. Equity arrangements with insiders are also covered by Section 5.02.11 under the SEC rules. The Form 8K must be filed within 4 business days of the reportable event. Prior to Sarbanes-Oxley, most of these events were reported periodically, just on like a Form 10Q or 10K, rather than at the time of the occurrence. If an issuer is required to restate its financial statements due to a failure to comply with the non-disclosure requirements as a result of misconduct by the CEO or CFO, that executive must also reimburse the company for any bonuses or incentive-based or equity-based compensation, including profits realized from the sale of company stock, received within the year following the first filing or issuance of the non-compliance statement. Misconduct is not defined in the statute, though, so this is broadened by the Dodd-Frank Act. The review includes many of the internal controls rules are focused on making sure the number of people with access to stock plan data is limited to those who really need it, and that adequate controls are in place to protect data and ensure that proper procedures are followed when equity is granted and transactions are conducted under the plan. Okay, and I think, nope, we have a couple more slides. I thought we were at the end. So going on is the fun blue sky laws that we had mentioned previously. These, again, are the state securities laws. These are the state laws regulating transactions in the securities. Again, they're similar to the 33 Act, and they prohibit sales of stock unless they're registered with the state securities commissioner or fit under an exemption. There are requirements for registration of the securities to be sold in that state. Non-public companies must comply with the blue sky laws for any states in which their company issues equity awards. And this is one of those places where a lot of times private companies will stumble. HR will move forward and hire somebody in a new state, and that information doesn't travel down to the equity team until an option grant is being made, and the equity team, or a small private company, it's probably one person, sees it and is like, whoa, wait, we have somebody in New York now. And then, they need to work with their paralegal team and securities team to make sure that they're following all of the proper blue sky rules in that jurisdiction. And public companies are eligible for stock exchange related exemptions from blue sky, state blue sky laws. Those are the state securities laws and regulations again. And then the last part, this is the most fun part, is federal preemption. Public companies are eligible for stock exchange related exemptions from state blue sky laws. Non-public companies must comply with the state blue sky laws for any states they issue awards. And then the federal preemption from securities applies only to state registration and qualification, but does not prevent states from imposing requirements to file notices and pay fees. And it may apply only to underlying securities, not the award itself. So that's all I've got.
Great. Great. Thank you, Christine. I really appreciate it. For candidates who are interested in some additional courses that may help with your exam preparation, we've listed a couple options on this slide. I also need to give the disclaimer that although this exam overview webinar is provided to help you with your exam preparation, it's not in and of itself sufficient exam preparation. We develop all of the questions for the CEP exams exclusively based on the CEP assigned textbooks, and you should study those materials thoroughly before taking the exam. This webinar is available to you for unlimited viewing until the exam date, and the same is true for the webinars for the other subject areas that are covered. So for accounting and plan design and administration and tax, those are all also available to you. So thanks everybody. Thank you, Christine, and good luck on the test.